Good evening, everybody. I want to thank everybody for tuning in this evening. My name is Clarence Harris. What this presentation will be financial valuation and acquisitions, an analytical approach to strategic growth. This is Norfolk CPA, Clarence Harris, and part of this presentation will be to fulfill some of the requirements that I have to do for my strategic management course at California Intercontinental University. So very excited about this presentation. The overview of this presentation. So we'll talk about the strategic rationale for acquisitions. We'll talk about some valuation techniques related to acquisitions and financial ratio analysis as it relates to mergers and acquisitions. So what are the reasons that a firm will want to acquire another firm? So we got a few of the reasons right here on this slide. Optimizing operational efficiencies. So acquisitions enable vertical integration, streamlining the value chain for improved operational efficiency and enhanced cost management. Then we have leveraging acquisitions to gain specialized expertise and proprietary resources. Companies can access and incorporate specialized expertise and proprietary resources, bolstering their competitive edge. Then we have diversification of business portfolio. This allows portfolio diversification, reducing risk and stabilizing revenue streams across different market segments. And we have achieving economies of scales, which helps lower cost per unit through increased production volumes and consolidated operations. Now, Nike is an example of a firm that employs a very unique acquisition strategy. For years, acquisitions has been part of their strategy, their culture. Up here we have 12 of their most notable acquisitions: Cole Haan in 1988, Bauer Hockey in 1994, Hurley International in 2002. One of the most notable ones is the Converse acquisition. Some folks didn't even know that Converse actually belongs to Nike. Yeah, the Chuck Taylors, the All-Stars. So they actually belong to Nike. Nike acquired them in 2003, and they acquired them for $315 million then. Did you know for the year ended 2023, Nike's fiscal year ends on May 31st. So for the year ended May 31st, 2023, did you know that revenues from Converse attributed to $2.427 billion? Let that sink in. So 20 years ago, they purchased it for $315 million. For the year ended, for the year of 2023, they earned $2.427 billion. Converse is doing their thing and making a good ROI, return on investment, for Nike. One of their most recent acquisitions is a website called letsrun.com. They got that in 2023. That's a website dedicated to running enthusiasts. So a lot of folks in the running community would go to this website. They'll learn things just specifically related to that community, some of the best technology and running shoes and events like that. So this was a very strategic move for Nike, so they can really capture that niche market of the running community, and they can introduce their products and services that Nike has to that very niche community. Moving on, financial valuation analysis. So when we're doing our valuation analysis, there are going to be some things that we want to look at. First, to come up with that valuation analysis, the financial statements are going to be very important. And For the folks that are on the call that have been in my accounting class, we all know what some of those financial statements are. We got our income statement, which shows your sales or your revenues and expenses for a specific period of time. The balance sheet, your balance sheet shows your assets, liabilities, and equity as of a specific moment in time. And your cash flow statement. Your cash flow statement is going to show your cash inflows and outflows for a specific period of time. Then we're going to look at what are the actual components of valuation. And then we're also going to take a look at the financial statement ratio analysis. Those are other metrics that we can utilize to see what's going on and measure what our acquisition is going to be and things like that. And we'll go more into the specifics of those financial statement ratios. Now, on this slide right here, what I have is an example of an income statement, balance sheet, and a cash flow statement. So in the left corner, here's your income statement. Again, it shows your revenues, your expenses for a specific period of time. We got year 1 and year 2. On the bottom left part of the screen, we have an example balance sheet showing our assets, total assets for year 1 and year 2, liabilities and equity for year 1 and year 2. And then we have an example cash flow statement. So we're using these examples, and it's going to be key, especially when we start to do our ratio analysis. So this is the company the example that we're going to base this off of. Now, when we talk about the components of valuation, now I'm just going to give you a disclaimer or a caveat, if you will. Valuations can be a very intricate process. So for the purpose of this presentation, we're going to simplify a lot of concepts just so you can have a good foundational grasp. But there are a lot of intricacies that we're not going to get into all the different things. So we're going to take a more simplified approach. But for the purposes of this presentation, here's how we're going to look at the components of valuation. We're going to take a value of what the net tangible assets are. And what are tangible assets? These are the assets we can actually put our hands on. Then we look at what the cash flows that the business is going to spit out and what we believe they're going to spit out in the future. And so based on what we believe the cash flows are that the business is going to spit out, we can actually assign a value, a dollar amount value to future cash flows. And then the third component of valuation would be the value of the intangible assets. Intangible, that's something you can't necessarily touch. It's the it factor. So we'll go into a little bit more of what those intangibles can be. Now, one thing that we're going to look at when we talk about our net tangible asset valuation, again, I got a lot of my students that are in my accounting course that I teach. And so one thing that we know is when you look at the balance sheet, the assets are recorded at their historical cost. So we can look at the balance sheet and we can get their historical cost less any related accumulated depreciation that might have been taken. However, when we're doing this valuation, we want to look at what the FMV meaning fair market value. What can we sell these assets for on the open market? We want to use the fair market value to really assess what the value of these tangible assets are going to be. In terms of the cash flow valuation, like I said before, we're going to project what is the cash flows that the business is spitting out. And why we can't use the income statement alone is the income statement doesn't necessarily show all cash inflows and outflows. Generally accepted accounting principles allows businesses and firms to operate on what is called an accrual method, which means revenues are recorded when they're earned, regardless of whether the cash is in or out. Expenses are booked on the income statement when they're incurred, regardless of cash being out or not. So, for the purposes of this presentation, we're going to determine what our free cash flow is going to be, and we're going to get that from looking at our cash flow statement. And then once we have what our free cash flow is going to be, and we can project what the cash outflows are going to, the free cash flows are going to be going forward, then the next thing we can do to determine the value of those cash flows is choosing an appropriate discount rate. And we'll talk about what is a discount rate. So we're going to get into that momentarily. So calculation of free cash flow. What we can do when we look at our cash flow statement or statement of cash flows, we're going to get our free cash flow from net cash from operating activities less our capital expenditures. The net cash from operating activities is the cash inflows and outflows related to the core business operations as reported on the company's statement of cash flows. Capital expenditures is the cash outflow from purchasing or maintaining physical assets such as property, plant, and equipment, also reported on the statement of cash flows. Determining the discount rate. So as I mentioned, once we kind of know what our cash flows are, our free cash flows and future cash flows, then we need to determine what is a discount rate. And what the discount rate represents is the firm's overall cost of capital. So firms have a couple of ways that their operations are financed. They're financed through equity and they're financed through debt, right? The discount rate or the cost of capital represents the specific rate that is required by those investors, stakeholders as a rate of return. The most simplified way I can say that is we can look at opportunity costs. So if we know that if we put our money in the next best investment, and that investment is going to yield us an 18% return on investment, then theoretically, that should represent our minimum cost of capital that we need to be using as our discount rate, okay? Now, going back to components of valuation. So I said it's going to incorporate three different things. I said the value of our net tangible assets, and then we're going to make a valuation of our cash flows. Now, I took this information from the balance sheet. So our net tangible asset value is going to be our tangible assets, the fair market value of all of our assets, which we have 10,250. All these numbers are in millions. So that's 10 billion, 10.25 billion. Our liabilities, if we go back to our balance sheet, came to 4.5 billion. So when we net those together, the net tangible asset value is 5.75 billion. All right. Now, if we look at our cash flows, and what I did for the cash flows, I made a very easy assumption. I took the average free cash flows from year 1 and 2, right? Which came up to 1.76 billion. And assuming we're making a couple of assumptions. We're assuming that our discount rate or our cost of capital rate is going to be 18%. And we predict that we're going to sustain this level of free cash flow in the future. If we use that 18% discount rate, we're going to value those cash flows at $9.778 billion. Okay, so when we add the value of the net tangible assets, the $5.75 billion, and the value of the cash flows at $9.778 billion, we come up with a total valuation before factoring in any type of intangible asset factor of $15.528 billion. Now, intangible asset valuation. Intangible asset valuation is informed by market benchmarks and specific methodologies such as the income, market, or cost approach, depending on the nature of the intangibles. If the acquisition price is below our valuation, excluding intangibles, it may signal that we have a value acquisition buy opportunity, potentially yielding undervalued strategic assets. So what does that mean? So if we look at this company, we looked at our tangible assets and our cash flows, and we came up to it's worth $15.5 billion. If we can buy this company for less than $15.5 billion, that means, that implies, that infers that we're having a value acquisition buy because we're buying it for less than what our valuation came to when we valued the actual tangible assets and the value of the cash flows. Just shake your head if that makes sense, if you follow me. All right. Now, if we have to pay over $15.5 billion, so let's say we have to pay $20 billion for this firm, if we have to pay $25 billion, $30 billion, $50 billion, anything above the 15.58, then we can assume that there has to be some sort of intangible factor to play, right? A purchase price exceeding our valuation must be justified by the premium associated with the company's intangible assets, which could include brand equity, proprietary technology, customer relationships, and all sorts of other factors. There is that it factor that is making it worth more than what the value of the tangible assets and the value of the cash flows are. Just shake your head if it's making sense thus far. Very cool, very cool. Now, I have put the financial statements up for reference, and soon enough, I'm going to put this up, but it's also going to have some of these financial ratios that we are about to talk about right now. So, key financial ratios. Ratio analysis is crucial in evaluating the financial implications of acquisitions, as it provides key insights into the operational efficiency, leverage, and overall financial health of the acquired entity. And some of the financial ratios that we're going to look at is going to be our liquidity ratios, leverage ratios, asset management ratios, and profitability ratios. For our liquidity ratios, what they do is they measure a firm's ability to pay its current obligations and continue operations. So, first one that we're going to look at is the current ratio, which takes our current assets divided by our current liabilities. The next ratio, liquidity ratio, we're going to talk about is the quick ratio, which takes our quick assets divided by our current liabilities. You might say, hey, Norfolk CPA, what is our quick assets? Our quick assets are going to be things such as cash, cash equivalents, accounts receivable. These are going to be examples of your quick assets. It's a more stringent ratio than the current ratio, and an even more stringent ratio than the quick ratio is going to be what we call our cash ratio, which is going to take our cash and cash equivalents divided by our current liabilities. And what are our cash equivalents? Cash equivalents, examples of those could be short-term stocks that we hold in our portfolio that we can easily sell. It could be Bitcoin or other types of cryptocurrency that we have it in our phone, and if we want to sell it right now or the next day, we can go ahead and convert it to cash very quickly. That's what is going to be cash equivalents. And then the other ratio that we can look at is our operating cash flow ratio, which takes the net cash provided by operating activities, which we can find on our cash flow statement, and we're going to divide that by our current liabilities. Now, the next set of ratios we're going to look at is our leverage ratios. These ratios measure the degree to which a firm uses debt or leverage to finance its assets and operations. We got our debt to equity ratio, which is essentially we're taking our total liabilities divided by our total equity. We have our long-term debt ratio, which is going to take our long-term debt divided by total equity. We got our interest coverage ratio, which takes our earnings before interest and tax. When you see EBIT, that means earnings before interest and tax divided by our interest expense, and our debt ratio is going to be equal to total liabilities divided by our total assets. The next set of ratios that we're going to talk about is our asset management ratios. These are efficiency ratios that measure the firm's use of assets to generate revenue and income. For everybody that's in my accounting class that's on the call, actually, in I believe our last class that we talked about, we actually talked about inventory turnover ratio. If you were in class and you remember me talking about that, just give me a thumbs up, shake your head, like, oh yeah, I remember you talking about that, Professor Harris. So what is our inventory turnover ratio? That's going to be equal to our cost of goods sold divided by average inventory. And we get average inventory by taking the inventory of year one versus the inventory of year two, taking the average of both of those to come up with an average inventory. Receivables turnover ratio, that's going to look at our net credit sales divided by average accounts receivable. Total asset turnover ratio, we're going to look at net sales divided by our average total assets. Fixed asset turnover ratio is going to be looking at our net sales divided by our average fixed assets. The next set of ratios are our profitability ratios. They measure the company's ability to generate earnings relative to sales, assets, equity, or other financial metrics. So we have our gross profit margin, which is our gross profit divided by sales, and we get gross profit from taking our gross sales minus our cost of goods sold. So everybody that's in my accounting class, you should know this one as well. Gross profit is your revenues minus your cost of goods sold. Our net profit margin is going to take our net income divided by sales. And our return on assets is going to take our net income divided by average total assets. Now we are back to our financial statements, and this time, and I know it may be very small, so you want to take a picture of it, blow it up later. If you want a copy of this slide deck, you can email me at thenorfolkcpa@gmail.com. So if you really want to get a bigger picture of this. But for the essence of being able to put all the ratios up here, I had to make it small enough that it can all fit. So So anyways, we have the various ratios. So we got our current ratio for year 1 and year 2. And again, our current ratio is going to look at our total current assets. So for year 1, total current assets is 2,800 divided by our total current liabilities of 1,300. So that's how we get to that 2.15. So we're essentially we went over what the formulas were for all of those ratios, and this is essentially just plugging them all in. Now, when you're looking at ratios, it's good to compare them from year to year, but what's also going to give you more value is if you can benchmark them against either the industry or some of your key competitors and your key rivals. For example, I had to do an analysis related to Nike Incorporated, and I had to do a lot of ratio analysis. And what I did was I benchmarked it against Under Armour. I benchmarked it against Adidas. So I was able to come up with all the various ratios, whether it was the liquidity ratios, the profitability ratios. And I said, okay, here's Nike's ratios, here's Under Armour, here's Adidas. And then you can get some really good, what we call comparative analysis. So this is going to be very critical when you're just whether you're analyzing firms. And for everybody that doesn't know, any of the publicly traded stocks, the firms that have publicly traded stocks, you can actually pull their financials up. They have a form that is called a 10K. That is the annual report. You can go to sec.gov or in your search bar, put Edgar Online. It's going to take you to where you can find all of these publicly traded companies where you can find their financial statements, all their informations, disclosures, and you can actually start to do comparative analysis. So you can kind of see how one company is comparing to another, whether it's through their profitability ratios, through their liquidity ratios, and things of that such. Now, I want to say this. Here's some presentation limitations and disclaimers. 1, educational intent. This presentation is designed for educational purposes only, and it is based on summarizing general information, not intended to provide any legal, business, accounting advice. There is no professional advice given. You should seek the guidance of your own CPA, your own attorney, business advisor, etc., etc. And I would just challenge everybody to read the rest of the limitations. So everybody that's looking at this on YouTube world, well, Norfolk CPA said this. I don't know your specific situation, but if you do want me to know your specific situation, you can reach out to me and maybe we can form a service provider client relationship. I would love to work with you, everybody out there in the YouTube world. Now, if you like this presentation and you are thinking about acquiring another company, or you need help with valuation, here are some of the professionals that might actually be able to help you. We got certified valuation analysts. They specialize in business valuation, performing comprehensive assessments. They are ideal for detailed analysis of company value and intangible assets. You could also go to folks that have the designation of a certified business appraiser. Like myself, I'm a CPA, a certified public accountant. CPAs are skilled in accounting and finance. CPAs that have experience in providing the valuation services, they are very adept at the financial analysis and valuation in line with accounting standards. Chartered financial analysts, the CFAs. They are experts in financial analysis and investment management. CFAs, that's a very strong credential. So if you're seeking some help, that might be someone that you want to consult with as well. Other professionals that might have experience related to valuations or some aspect of it. You have your investment bankers who could specialize in mergers and acquisitions. Corporate attorneys can help you out, and other experienced professionals. Now, I want to put some of the references that I utilized. Most of these references came when I talked about the Nike example. So I did pull a lot of information from the annual report. We talked about that 10K that you can go find from sec.gov. So I pulled a lot of the financial information from Nike's 10K, as well as these other two articles that highlighted some of those key acquisitions that Nike has done over the years. So be sure to check out those website links if you want to get a little bit more information. And I do want to give them their props by acknowledging them as a reference. Closing announcements. Business tax and accounting services. If you're seeking assistance with business taxes or accounting, my team and I are here to offer support. Please don't hesitate to reach out for help. You know, there are a lot of business owners, entrepreneurs, they are journeying in the business startup game or in the business game all by themselves, and they don't have a CPA. If you don't have a CPA that is in your life, guess what? I'm here to help. IRS debt and unfiled tax returns. Hey, if you're a business owner and you're scared of the IRS, you owe the IRS a lot of money, $50,000, $60,000, $70,000, $80,000, $100,000 or more. You're getting these scary letters. We want to lien you, levy you, take all of your money. Guess what? We're here to help.
Amen.
I got you. You need to see me after the presentation. That's why I put it out here. So you don't have to be alone. You don't have to fight these things alone. Norfolk CPA, I'm here to help. Also, what I want to talk about, number 3, upcoming music, book, and album. I'm very excited. I got a new book. It's slated to come out April 15, 2024, called 10 Rules for Entering the Business Startup Game. I'm very excited about this project, and it also has a hip-hop album that comes out with it that is produced by me. So for folks that don't know, yes, I'm very musically inclined. And all of the music deals in hip hop format. All the songs are business related, entrepreneur related, real estate focused. So it's really going to be a game changer, and it's going to give good quality music to folks that are in the business entrepreneurship. Honestly, everybody in the hip hop industry should check it out. Everybody in the hip hop industry, you should know that I am hip hop's first CPA. Norfolk CPA. If you need to contact me, I see Ethan laughing at me. If you need to contact me, here's my contact information. You can email me at thenorfolkcpa@gmail.com. I'm on IG at Gmail. If you're on LinkedIn, you can take your phone out, scan the QR code right here, or you old school and just want to put the link in, you can do that as well. I want to thank everybody that's on the live call tonight, and everybody that is watching this on YouTube, and everybody that's going to refer me to some clients that might have some tax issues, valuation issues, or you want to check out the book. I thank you in advance. Everybody that's going to let everybody in the hip hop industry know, like, listen, this is hip hop's first CPA. We need to go to him. He's the only one that can demonstrate that he's a CPA that knows his business, and he can demonstrate that he's really about the hip hop culture and not one of these culture vultures. That's why you got to go to Norfolk CPA. So with that, my name is Norfolk CPA, and I approve this message. Thank you, everybody.
Ooh, big hairs. Ooh.